When trading in the Forex market, it's important to be aware of gaps. Gaps are areas on a chart where the price of a currency pair moves sharply higher or lower, with little or no trading in between. Gaps can occur at the market open or close and during intraday trading. When a gap occurs, it indicates that there is an imbalance of buyers or sellers in the market. Gaps are caused by a number of factors, including news announcements, changes in market conditions, or simply a lack of liquidity. Gaps can create both opportunities and risks for traders, so it is important to understand how they work. There are two types of gaps: gap up and gap down. A gap that occurs above the previous closing price is known as a gap up, and one that occurs below the previous closing price is known as a gap down. For example, if a commodity trades at $2 during the first hour of trading, and then opens at $3 in the second hour, this is a gap up. If the price had opened at $1.50 instead, this would be a gap down. Of course, trading gaps come with risks too. If a trader enters into a position only to see the market quickly move against them, they could experience heavy losses. Here's a major risk with gaps. A gap can go past a stop-loss order and beyond the intended price of entry. Stop-loss orders tell you how much you stand to lose, but if the market gaps across your order, you lose, and your loss may result in a larger loss than expected if a stop-loss is crossed over or gapped through. Let's say you buy a stock for $60. You set your stop-loss order at $55, so if the price went below $55, you would be stopped out, losing $5. Your stop-loss will not be executed at $55 if something happens overnight, and the stock opens at $25, giving you a loss of $35 per share. The opportunities that gaps can create are huge. While most traders try to avoid gaps, there are some that see them as opportunities. Gaps provide an opportunity to enter the market at a price that is not available during regular trading hours. This can allow traders to get into positions that they would not have been able to otherwise. There are two main types of gaps: breakaway and continuation. Breakaway gaps occur when the price breaks out from a consolidating pattern and usually signal the start of a new trend. Continuation gaps happen within an existing trend and usually indicate that the trend will continue. In order to reduce the risk associated with gaps, you can follow the following steps. During potentially volatile weekends such as the non-farm payroll, it's best to avoid holding positions. Avoid holding positions ahead of earnings unless you are trading earning expectations. Additionally, you can purchase put options, which will cover the loss if the underlying stock gap lowers. That's all for today. See you on the next one.